Good morning to you both. Omar, I'll start with you. The fact that we have another day with a lot of red arrows. We've seen this big rotation from growth into cyclicals as interest rates have moved higher and moved higher pretty quickly. I feel like we've had this conversation and we've seen this playbook before, probably just a couple times in 2021 alone. So how sustainable is this move we've seen, and how are you counseling investors right now?
Well, good morning, and thanks for having me. A few things. Yes, you're completely right. These sort of head fake changes into the business cycle have been very common over these last 2.5 years. But we have seen consistency in many other areas. Now, what I think is different this time is that unlike the last time we talked about this potential rotation, is that we now have higher inflation that we actually see and observe. We also have the prospect of higher interest rates and a reduction of the Fed balance sheet. Those two variables alone are very different from the last time that we actually spoke, that cyclical rotation and that cyclical leadership. The biggest part in this particular phase, or in this particular moment, is the fact that investors just don't know how to price, the potential for those higher interest rates. And that is very well confirmed by the fact that last week alone, we saw 20 plus basis points move in the 10-year yield, which, in equity, sort of dimensions is not a lot. When you actually think about that move and what represents over the last 2.5 years is more than 2 standard deviations.
And of course, Brian, what we have seen is a sell-off in software, internet, growth, some of the more speculative names that trade publicly. How low can we go from here when you look across your coverage universe?
Yeah, good morning. Thanks for having me. I think when we sort of look at the sell-off in the space, a lot of the higher multiple enterprise software names have been impacted, as well as some of the higher multiple consumer names like Snapchat, like Pinterest, et cetera. But I actually sort of come back to the far more GARP-oriented big cap tech. We are at a situation now where companies like Alphabet, Facebook, Amazon, these are companies that now, because of last year's performance and now the initial sell-off, are sort of trading at low double-digit forward free cash flow multiples for what's likely to be high teens to maybe 20% free cash flow the next few years. So, we go through these periods of reset and turbulation, but I do just kind of want to emphasize big cap tech is actually not that expensive relative to history or relative to what we think is going to be the forward growth potential.
So, Brian, just to dig into that a little bit more, what's on sale from your standpoint right now? What should investors be buying?
We're very bullish this year on Amazon. We think Uber is underappreciated for the potential cash flow to come from the rideshare business. And then just to come back to the online advertising industry with Alphabet and with Facebook, we think the overall online advertising markets continue to be very strong heading into 2022. And so those are the areas I would look. I would look at Amazon, I would look at Uber, and then I would just sort of step back and say, what's still happening in online advertising? And the answer is more dollars are still moving into the online ad markets faster than before and in larger quantities than before. And so these big cap companies like Facebook and Alphabet, we think also screen very attractively on a valuation perspective.
Shepard Smith here. Thanks for watching CNBC on YouTube.